$11 billion. That is the number behind one of the biggest accounting frauds in American history. WorldCom did not collapse because it had no customers. It did not collapse because telecommunications disappeared. It collapsed because the company made its financial results look better than they really were. And the mechanism was shockingly simple. WorldCom took normal business expenses, and instead of treating them like expenses, it treated them like assets. That one accounting trick helped turn ugly losses into fake profits. And for a while, investors believed the story. Wall Street believed the growth. Employees believed the company was still strong. But underneath the surface, the numbers were being manipulated. This is the story of WorldCom, a telecom giant that looked successful from the outside. But inside, the company was hiding one of the biggest financial lies in corporate history. Before the scandal, WorldCom was huge. It was one of the biggest telecommunications companies in the United States. It carried phone calls. It handled internet traffic. It owned massive networks. And during the 1990s, telecom was one of the hottest industries in the market. The internet was growing. Businesses needed data networks. Investors believed demand would keep rising. And WorldCom looked like it was building the future. At the center of the company was CEO Bernie Ebbers. WorldCom grew through acquisitions. It bought company after company. The empire expanded. The stock price rose. And the company became one of the biggest names in telecom. But fast growth can hide dangerous weaknesses. When a company keeps buying other companies, the numbers get complicated. The structure gets complicated. The story gets complicated. And complexity can become a hiding place. WorldCom needed to keep showing growth. It needed to keep Wall Street confident. It needed investors to believe the company was still strong. But then the telecom boom weakened. Demand did not grow as fast as expected. Competition increased. Prices came under pressure. And WorldCom's real business performance started getting worse. That created a problem. The company had promised the market a growth story. But reality was no longer matching the promise. So the numbers had to look better. And that is where the fraud began. To understand WorldCom, you only need one accounting idea. Expenses reduce profit now. Assets are spread out over time. That is the trick. Imagine a business spends $1 million this year on normal operating costs. If it records that as an expense, profit drops this year. But if it pretends that same cost is an asset, the full hit does not show up right away. It gets spread over future years. So the company looks more profitable today. That is what WorldCom did with billions of dollars. One of WorldCom's biggest costs was line costs. These were fees WorldCom paid to use other companies' telecom networks. Line costs were normal operating expenses. They were part of running the business. They should have reduced profit when they happened. But WorldCom moved large amounts of these costs onto the balance sheet as capital expenditures. In simple language, WorldCom took costs that should have hurt profit immediately and treated them like long-term investments. That made expenses look lower. It made profits look higher. It made the company look healthier. But the health was fake. The money was still gone. The cost still existed. The only thing that changed was how the accounting made it look. That is why accounting fraud is so dangerous. Nothing has to explode in the real world at first. The phones still work. The offices still open. Employees still show up. Customers still receive service. But the financial statements are telling a story that is not true. And investors rely on those statements. They use them to decide whether to buy, sell, or hold the stock. So when the numbers are fake, the market is making decisions inside an illusion. WorldCom's fraud also involved other accounting manipulations. But the clearest mechanism was the capitalization of expenses. That was the machine. Move expenses into assets. reduce current costs, increase reported profit, protect the story. And once the company started doing it, stopping became harder. That is the trap. The first manipulation may make one quarter look better, but then the next quarter arrives. The real business is still weak. The pressure is still there. Wall Street still expects results. So the company has to do it again. Then again. Then again. The fraud grows because every fake number creates the need for another fake number. That is how a temporary trick becomes a giant scandal. WorldCom's executives were under enormous pressure to meet expectations. The company's stock had been a major part of its identity. Its growth story was built into the market's trust. If the numbers collapsed, the stock could collapse. If the stock collapsed, the acquisition machine could collapse. If the acquisition machine collapsed, the whole story could collapse. So instead of admitting weakness, the company hid it. WorldCom was not just hiding numbers. It was hiding the end of a story. The story was that WorldCom was still a high-growth telecom powerhouse, but the real business was under pressure. The numbers were not strong enough, and leadership did not want the market to see that truth. The fraud eventually became too large to hide. Internal auditors began uncovering suspicious accounting entries. One of the key figures was Cynthia Cooper, WorldCom's vice president of internal audit. Her team investigated the numbers and found billions in improper accounting. That discovery helped expose the fraud. And when the truth came out, the damage was massive. WorldCom announced that billions of dollars in expenses had been improperly accounted for. The scandal exploded. Investors were stunned. Employees were shaken. The market saw that one of the biggest companies in America had been reporting numbers that could not be trusted. In 2002, WorldCom filed for bankruptcy. At the time, it was one of the largest bankruptcies in U.S. history. The company that once represented telecom growth became a symbol of corporate fraud. The collapse happened during a brutal period for corporate America. Enron had already collapsed. Investors were already losing trust. People were already asking whether major public companies could be believed. Then, WorldCom hit, and it confirmed the fear. The numbers on the page might not be real. The executives might not be telling the truth. The auditors might not catch everything. The board might not know enough. And employees might pay the price. That is one of the painful parts of WorldCom. Corporate fraud does not only hurt investors, it hurts employees. People build careers inside these companies. They invest retirement savings. They believe leadership. They believe the company is stable. Then the truth comes out, and ordinary workers are left with the damage. Bernie Ebbers was later convicted for his role in the fraud. Chief Financial Officer Scott Sullivan pleaded guilty and testified. The scandal became a landmark example of accounting manipulation, executive pressure, and failed controls. But the most important lesson is how simple the core fraud was. WorldCom did not need an impossible financial invention. It did not need a complicated derivative. It did not need a secret offshore empire. The heart of the fraud was basic. Take expenses. Call them assets. Make profit look better. That simplicity is what makes WorldCom so important. It shows that corporate fraud does not always require genius. Sometimes it only requires pressure, weak controls, and people willing to cross the line. Now let's talk about the psychology of the collapse. The first psychological force was growth addiction. WorldCom had been rewarded for growth. The company grew through acquisitions. The market rewarded the expansion. The CEO was praised. The stock became powerful. And once a company becomes known for growth, slowing down feels like failure. But no company grows forever at the same speed. Eventually, reality catches up. Markets mature. Competition increases. Costs rise. Demand changes. But if leadership cannot accept slower growth, it may start manufacturing the appearance of growth. That is what happened at WorldCom. The company could not make the business match the story, so it made the accounting match the story. The second force was fear. Executives feared missing expectations. They feared Wall Street reaction. They feared the stock falling. They feared admitting that the company was weaker than people believed. At first, the decision may feel temporary. Just adjust this quarter. Just get through this period. Just buy time. But fraud does not usually stay temporary. It compounds. The lie from last quarter becomes the starting point for the next quarter, and the company becomes trapped inside its own deception. The third force was authority. When senior executives push a number, people lower in the organization may feel pressure to accept it. They may know something feels wrong. They may question it quietly. But challenging leadership can be hard, especially when the company is large, especially when the CEO is powerful, especially when everyone believes the company must protect the stock price. That is why internal controls matter. A company cannot depend only on trust. It needs systems that can say no. It needs auditors who can investigate. It needs finance teams that can challenge bad entries. It needs a board that understands the risks. And it needs a culture where truth is safer than silence. WorldCom gives us several clear lessons. Lesson 1. Cash reality matters more than reported profit. A company can report earnings, but if the accounting is manipulated, those earnings can be fiction. Lesson 2. Expenses are not assets just because management wants better numbers. Accounting rules matter because they protect trust. Lesson 3. Growth stories should be questioned when the industry is weakening. If the whole market is under pressure, but one company keeps reporting amazing results, investors should ask why. Lesson 4. Internal audit can save a company from deeper damage. Cynthia Cooper and her team showed why independent internal review matters. Lesson 5. Culture decides whether warning signs become action. If people are afraid to speak up, the fraud can grow. If leaders punish bad news goes underground. And the final lesson is simple. When a company cannot admit reality, the numbers become dangerous. WorldCom wanted to keep looking strong, so it changed how weakness appeared on paper. But paper strength is not real strength. Eventually, the truth comes out. The expenses were real. The pressure was real. The weakness was real. The only thing that was fake was the story investors were being told. That is why WorldCom belongs in the corporate collapse library. It was not just a telecom failure. It was not just an accounting scandal. It was a warning about what happens when a company protects the stock price instead of the truth. WorldCom turned expenses into assets. It turned weakness into illusion. For a while, it worked. Then it destroyed trust. And once trust is gone, even a giant company can fall fast. $11 billion. That was not just an accounting error. That was the size of the illusion. If you want more corporate collapse, fraud, and financial disaster breakdowns, subscribe to the channel. And watch the next case study, because WorldCom was not the only company where the numbers told a story that was not true.